Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is April the 10th, 2023. It is now 3:45 p.m. Central Time. We have 15 minutes left in the trading day for the bond market and mortgage-backed securities. So we're going to take a look and see where we are. Now, we have a couple of things to talk about today, big things to talk about today, one in the rearview mirror and one to come. So first of all, we had a shortened trading day because of the holiday on Friday, but it was an eventful day because we did get the Bureau of Labor Statistics employment reading, and unfortunately, that employment reading came in about what the markets expected. And what we need to see in the home loan interest rate world and in the bond world is we need to see weakness in the employment numbers in order for home loan interest rates to come down, which is what we would call improve. The market came out, or the numbers came out showing about what the markets expected. I believe it was 236,000 job creations. And unfortunately, while everybody pretty went, okay, that's good, things look good in employment, that's not what the bond market felt. So unfortunately, home loan interest rates did increase on Friday, and then Saturday and Sunday held about the same. Here we are on Monday, and they're sticking about the same. Not a whole lot of movement. We're going to take a look here in just a moment. Let's just go ahead and jump over and look at the charts here. So if we go over to today's charts, we are currently down 3 basis points, pretty steady. 10-year Treasury is up 2. You can see that the mortgage-backed security, we were up here above our 200-day moving average, having a little party, dancing on the ceiling of the 200-day moving average, but unfortunately fell through pretty hard there on Friday, and here we are on Monday, moving around here, trying to stay above this Fibonacci level and this 100-day moving average that we're sitting above right now. I think we'll probably land a little bit above these two technical indicators here and get ready for what is to come. So this is what you really need to know right now. When you look at the charts that I put out on a regular basis for the personal consumption expenditures and the consumer price index numbers, which are our two biggest measures of inflation that we pay attention to understand what the market is going to do. We usually look at that and say, hey, we need to have a number that is a 0.3 month over month, a 0.2 month over month. This month is going to be tough. This is going to be what I'm going to kind of describe it like this. The dragon that we have been facing of inflation is going to raise its head one more time. And it's going to raise its head one more time this week. This week is the last expected report that could be very painful on the inflation front. Now, things can happen. The government can come out and decide to launch another $2 trillion in stimulus and just annihilate my expectations because it's tremendously inflationary. But when we look at the historic numbers, there is a concern with the report that is coming out on Wednesday of this week. So let's take a look and show you. Now, first of all, we know that there are 4 reports that I talk about, or 4 events that I talk about pretty much every month. The first is what the Federal Reserve does to the federal funds rate, increasing or decreasing the federal funds rate. They do that based on a few reports that they analyze. The number one and most important report in the eyes of the Federal Reserve is the personal consumption expenditures report. That is their favorite measure of inflation. So that's my report number 2. So report number 1 is the Fed's announcements. Report number 2 is a personal consumption expenditures report. Report number 3 is a consumer price index, which is another measurement of inflation. And then number 4 is the producer price index, which is a measurement of wholesale inflation. Okay, so that's kind of how we look at things. On Wednesday of this week, we are getting the consumer price index. So that's number 3 on the list, but it is very highly respected, and highly analyzed. Well, what is the number that we are trying to replace? Because that's how we take a look and see what we anticipate. And here's the concern. So when we look at our historic charts, now this is a chart that has been provided, and we look at through more MBS Highway, the group that we get most of our statistics and data from. So I always like to put their name out there. Thank you to the team from MBS Highway. But this is what we show here, is that when we get our April report, when you get an April report, it is a reading that is for the previous month. So when we get our reading here on Wednesday, it is going to be April's reading of March's numbers. Okay, so it is for the month of March. And look what happened here. So in February of 2023, it came in at a zero point 0.5 number. That's a fairly high number. That would give us a year over year reading of 6% on inflation, which is very high if that was the static number for an entire year. But here's the concern. In the historic numbers, March of 2022, there was a dip in inflation. There was a report that was a dip in inflation, and it showed inflation coming down quite a bit. What that means is that it is difficult to beat a zero point 0.3. We have to come in lower than these numbers to show inflation coming down. And when you have March showing a reading of zero point 0.3, there is a lot of room for us to come in with a report above zero point 0.3. If we have a report that comes in above zero point 0.3, then that is going to be looked at as inflation is back. Inflation is rearing its head again, but it is going to be temporary. We do not see this as something that is going to say, hey, inflation is back, but it was a little bit of an anomaly that happened in 2022 that is going to kind of bite us here in 2023 as we try to show inflation coming down because that was a lower inflation reading. So you have to understand that number one, this is going to be hard to beat this week. We're probably going to see headline numbers that are core readings that are above zero point 0.3, and everyone's going to go crazy saying inflation is back. Home loan interest rates are not going to like that, and they're going to shoot up if that is the case. But look at the next reports. So this is why this should be the last time that inflation rears its head, because then we go 0.5, 0.6, 0.6. These are much easier reports to beat. And we also believe that the shelter component of both CPI and the personal consumption expenditures reading is going to show inflation really dissolving. So I'm sorry, inflation, shelter dissolving. So the cost of shelter is going to show a very consistent reduction from the previous months, which is going to allow our readings to show inflation is subsiding. The effects of the increases of the federal funds rate are doing their job, and inflation is going to come back under control, which is what we need to see for home loan interest rates to come down. That is what I'm warning about, is that we expect there to be a spike in inflation. They're going to kind of put it out there like a spike in inflation, most likely on Wednesday. Now, the producer price index report comes out the following day on Thursday. We do believe that the producer price index is going to show inflation subsiding. So it'll help. But again, we're going to have the report number 3 come out ugly. So report number 4 isn't going to just solve that problem. It's going to help, but it's not going to solve that problem. So we're going to have to really see what happens to this report that comes out on Wednesday, which is the Consumer Price Index report. And what you need to be listening for is we want the core reading of the Consumer Price Index to be under zero point 0.4. I think it was 0.4, 0.3. Let's take another look. Maybe it's 0.3. I'm losing my mind here. So 0.3, yeah, 0.3. We want it to be at or under zero point 0.3, which is pretty darn low. Okay, so that's why we are concerned. Where are we right now on home loan interest rates? Let's go back over here, shrink this down, take a look at our loan sifter, run the Brent Bruce Daily, which is our very well qualified 30-year fixed conventional home loan. And we are sitting at, rather than being at 6.125, guys, we're at 6.625, a 0.5% increase just from one employment reading that came out. Have you noticed, if you watch this report, and you have been for a number of months, that these employment readings, man, they should be on my top 4, right? They're more impactful lately than our producer price index for sure. So maybe I need to readjust my top reports that I talk about. We're at 6.625% with a little bit of a credit of $799 with our top bank right now, Flagstar. Remember that you cannot call these banks and get loans from them. You need to go through brokers. I mean, some of them you can, but you're not going to get these rates. Let's take a look and see. United Wholesale, which we've been tracking and watching for a long time. What does it take to get to that 5.999? 1 point. Okay. Now you remember that not only a couple weeks ago, maybe a week and a half ago, we were talking about a 5.999 with a cost of 0.13. 0.13. Now we're talking about 1.016. So there has been about a 100 basis point increase, a full percent increase in the cost of getting a 5.999% interest rate here in the last 5 days. Okay, so you can see how quickly these things move and what we need to do to get it back down. I'm going to open this up here. I'm going to show my scenario here for compliance purposes. We're going to close that out. And we're going to make sure that you understand that you need to subscribe, like, and share in order to get these reports on a daily basis and stay on top of what is really going on. We do expect it could not, I could be wrong. We could get a surprise report, but we should expect that home loan interest rates are going to go up this week. We may see 6.875% as the rate we're talking about on the Brent Bruce Daily for a moment. And then that should be the end of the last effort of inflation to beat our interest rates up as we roll through our second quarter and we charge toward lower rates in the low fives, maybe the high fours by 7/1, July 1st, 2023. I will talk to you again soon, let you know what's going on. Make sure that you like, subscribe, and share. Talk to you then.